All right. Well, we will go ahead and get started here. Good afternoon and good morning to some. We appreciate you taking time out of your busy schedule to join us here today. My name is Travis Lidkey. I'm a Value Legacy Solutions coach with Advisor Legacy. And joining me today is Todd Doherty, our Vice President of Legacy Solutions. He's going to be leading the majority of today's discussion. Today's webinar, as you can see here, titled 2029, The Great AI Disruption. Um, and before I hand things over to Todd, I'd like to just take a couple minutes to share a little bit about who Advisor Legacy is and what we do for financial advisors. Um, we help financial advisors turn a successful practice into a lasting legacy. We guide advisors through growth, continuity, succession, and business transitions so they can protect their clients, support their team, and really create a future for the business they've worked so hard to build. We believe a great advisory practice should continue creating impact well beyond the founder's career, and that's what we call a legacy firm. And the way we do that really is in three different life cycle stages of a practice, and that's being build, live, and leave a legacy. So when we think about those stages, the first stage is the building stage. And in that stage, we're helping you build infrastructure and systems, developing leadership of the practice, and create enterprise value. The outcome really of this stage is being a structurally sound firm. The next stage or the middle stage here is living a legacy. Um, in that stage, we're helping develop founder independence. We're helping you develop leadership capacity and aligning the practice with your specific lifestyle. The outcome of this stage is really being a firm that supports your life. The final stage, and this is really the area of the business that Todd and I are deeply involved in. This is the leaving of a legacy, where we're going to help you with succession planning, helping you if you've already found a buyer for your practice or if you're buying a practice. If you're selling your practice and don't have a buyer, we can help you find one. And then we also help with the ownership team and client transition and really maintaining the legacy of the business that you've built. Again, the outcome there is a firm that endures beyond you, whatever path you choose for your succession. Um, so that's a little bit about what we do. I do want to give a quick housekeeping note before I do hand it off to Todd. All participant lines, they've been muted to minimize background noise. However, we absolutely encourage questions throughout the presentation. So as we move along, please feel free to submit questions using either the chat feature or the Q&A section. You should see that at the bottom of your screen. And then at the end, we're going to address as many of those questions as we can. So with that, I'm going to turn it over to Todd, who's going to take us through today's content.
Thanks, Travis, and thanks to all of you again for taking time out of your busy schedules to join us. Certainly, the topic that we're covering today is really on the minds of a lot of advisors. I've been doing speaking engagements through the industry as of late, and we find it's really one of the most engaged subjects on people's minds today. Personally, I have a wider lens for this subject as well that goes beyond just the impact in our industry, as important as that is, based on a book I published called The Symbiosis Blueprint. And what that book addresses is the larger lens of how humanity can work with AI, and really a blueprint for doing that successfully and avoiding a lot of the negative scenarios that the media likes to focus on so often. It happens as well that even though this subject is, such a top of mind subject in our own industry, a lot of the narrative has been negative, and I think that a lot of that's fueled by media. We're not here today to provide that narrative. We believe that the narrative is largely around opportunity. While there is some risk for people that don't want to adopt these changes, the larger opportunity is really the greater message that we're going to have today. So let's start off with what I like to call the $1 billion question, and that is how is AI going to impact the financial services space? If we look at it today, largely I would describe it as being a mile wide and an inch deep. The way that people are using AI, and it hasn't been really deeply integrated into our systems and processes, is it's been really sitting on top of existing tech stacks and operational stacks. And what that looks like for many people is they're using it for meeting note taking. They might be using it for drafting emails, maybe doing some chat type of engagement on the side. But really, that has been a shallow layer, as we would refer to it. And I really think that shallow layer is creating a false sense of security because it hasn't changed things that greatly yet. What we think moving forward is, the way that this is accelerating is extremely fast, and the capability of the systems is certainly accelerating faster than the implementation, that by the year 2029, so only 3 years from today, we'll go from being a mile wide and an inch deep to a mile deep. And what that will look like is, those AI systems penetrating all the way down into those tech and operational stacks, either operating independently in them, and in some cases probably replacing those tech stacks completely. And that's where it really starts having a significant impact on our industry, and also where we think there's a huge opportunity here in terms of making practices more efficient, profitable, and valuable. And I'm going to be talking a lot about that today. So again, this is only 3 years from today that we think that we're going to go from shallow implementation to deep implementation, and where the real impact will be seen across our industry, and probably the largest change that most of us will experience in our careers. I've been doing valuations for at least 15 years now. And one of the things that I want to talk about is how this is going to impact valuation, because it really is part of the foundation of today's discussion. So over that time frame, we've seen what I would refer to as incremental increases in practice value. And what those have come from largely is, improvements in recurring revenue, improvements in client segmentation, profitability across the board has improved over that time frame. And also we've had certainly a really strong market for practice acquisitions. But those improvements have been incremental. And what that looks like, from a multiple standpoint, if we just use a simple multiple of gross revenue, is 15 years ago, the average was about a multiple of 2, and today the average is a multiple of just shy of 2.4. So certainly that's a nice increase from a dollar perspective, but we've never seen a more significant increase for one specific reason largely, and that is there's a constraint on value. And the constraint on value is scaling efficiently. When practices grow in size and revenue, as they move up through the revenue ranges, the expense ratio also increases, and that has been the constraint on value. What we think AI will provide, and I think this is a pretty safe bet, is removing that constraint on value largely and allowing practices who adopt it deeply to grow without growing, relatively speaking, their expense ratio. And the more margin you release, the more value you release in the practice. The opportunity that creates is likely going to be multiples of revenue in terms of valuation that we've never seen in our industry before. And I think that is a pretty significant opportunity and something, to really look forward to. The other trend that we've seen, if you want to just go back one, Travis, for a second, sorry, is there's been probably about 5 years now what I would refer to as a bifurcation in two business models in our industry, and certainly favoring the latter. The first model is what we refer to, and this is the older model, if you will, is an advisor centric, what many of you might understand as a book of business model. Heavily reliant on the founder as the advisor, those relationships, and really the founder driving the growth of the business. The newer business model is really a more scalable, more resourced, more process and systems driven enterprise. And why this is important in our discussion today about AI and the impact on our industry is it's likely the difference between those two models will become greater and greater as the old book of business model is more tech challenged and the enterprise model becomes more tech enabled. And the further apart those models get, the less valuable the book model becomes and the more valuable the enterprise model becomes. And that's a theme really throughout this presentation. So if we look under the hood, what is that going to look like, or what does it, partially look like today, but what is AI really going to unlock to make that difference just greater and greater over the next 3 years or so? In terms of service process in the book model versus the enterprise model, the service process in the book model is largely manual. If there's more than one advisor in the practice, they probably do things differently, et cetera. And, the tech-enabled enterprise model is largely going to be scalable, automated, consistent. And so, the service of the clients is largely going to be based on a process where the clients get the same service regardless of which advisor is servicing them. They may be serviced by a team, et cetera, versus, an older type manual and bespoke model. In terms of relationships, largely in the book of business model, it is very, very heavily founder-centric, or relies, almost exclusively on the founder. If there's two advisors or a partnership, it relies on two. And that's the only difference. It's not really an institutionalized and systematic approach to managing the client relationships based on having a relationship more with the team than with any one specific advisor. Continuity, there's a lot of risk in the older model, and it's that key person risk largely around the core advisor, the founder, owner, if you will, and any other primary advisors that are in the practice. The more systematic approach certainly reduces that key person risk substantially because the practice is operating on systems and processes, not as much dependent on personalities. And then when we look at the constraint, as I mentioned before, this is the big ticket item, and they all kind of add up to this actually. And when you think about growing a practice, with the book of business model, it really becomes a linear process. And when I say linear process, and I'll say that a couple of times today, that's what we do as people, So a linear process means if I'm going to grow my client count, that means I have to hire more advisors, I have to hire more staff. I'm duplicating those linear processes over and over again, or just increasing them. And that creates the constraint on margin and the constraint on valuation. If we unlock a lot of those linear processes with compute and literally replace some enhance, etc., then those systems that are digital based, compute based, have almost unlimited scalability, and the more that you scale them, the lower the price goes. So those are very, very distinctly different models, where one growing through increasing linear models, another growing through increasing digital and system based models. And at the end of the day, the difference is becoming, and this bifurcation started about 5 years ago. When someone's looking at a book model for sale, they're essentially buying revenue. But when they're looking at an enterprise model for sale, and that's become, the favored acquisition model, they're buying future capacity of a professional team supported by tech. very big differences, and the larger that difference becomes, the greater the differences in value are. So diving a little bit more into that, that thought process of how do you scale without creating more and more linear models, and how do you create more efficient use of AI? And the other thing that happens here, which I think is really significant, is as those tools, if you want to call them tools, it's really an intelligence, go deeper and deeper into the systems that you use to manage your practice, it really allows the advisor's time, which is the most valuable in your business, to be aligned where the value is. And what I mean by that is, there's big differences in the profitability of the different segments of clients you have. For example, clients that have below 100,000 in AUM, their average profitability is approximately $300. Clients that are over 500,000 in AUM, their average profitability is in excess of $5,000. So those are really significant differences, and a really efficient, profitable, and valuable practice will align its most valuable resources where the value is, which is, of course, the affluent and high net worth clients. If we look at this implementation wheel, if you will, of technology, largely AI technology, it's going to allow you to do exactly that. So when it gets deeply integrated into, things like data collection, analysis, lower end management of the clients, all of these things create this, this flywheel effect of increasing margin, increasing efficiency, increasing profitability, but also largely aligning the resources where the value is largely in the practice, which is those affluent clients. The other thing that we've seen, and this is just a general comment that happened before AI was even present, is when practices improve their segmentation, even without technology, and they really realign their resources with the higher net worth client segments, they tend to see the future growth come from those higher net worth segments. And it's clear why. It's just because they're providing more service there, they're putting more time into those clients, and they're getting more referrals from that lane. So all of this is going to have the impact of creating a more efficient, more scalable practice, and the more you scale it with the technology basis, the more efficient it becomes. So the larger you get will reverse the trend of an increasing expense ratio. So let's take a look at what this really looks like today in terms of numbers. And while the multiples are debatable, it's a little bit hard to quantify. The concept is absolutely solid, and in knowing that there's a difference between the two. This is our best estimate on multiples, and I feel like it's pretty darn close to what we're experiencing today, and that gap will grow. So if we look at the average, and again, we're just using simple multiples of gross revenue, tech challenged, if you will, book of business, and I would argue, those models have been tech challenged before AI was even introduced, and it's only in the early stages of introduction today. So they've been less likely to adopt what's already been available to them to run their practice more efficiently based on systems and processes. So average multiple for that type of business today, probably around 2.2, 2.3 for valuation. The tech-enabled enterprise practice, again, larger practice normally, more resources in the practice, not founder-centric, but operating on systems, processes, etc., which is more likely to adopt AI as a technology. Already we see a gap there. So 2.23 versus about 2.7 existing. And if you apply that, using some simple math and a simple example, if you will. So if a practice is 1 million in gross revenue today, the difference between those two, or the gap between the two, is already $460,000 in value on average. So that's our starting point. So let's take a look at, what we think is going to happen, again, in the next 3 years by 2029. as the difference between those two models becomes greater and greater. And I know some people are probably thinking, well, why would the book of business model decline? And we have a very specific example of that that's already happened in our industry. I want to dive into a little bit deeper before I move on with this particular slide. So 10 years ago, approximately, average recurring revenue in our industry was about 74%. So in those days, it was common that practices did a fair amount of transactional revenue, whether that's annuities, etc. And the difference between a more transactional practice and a practice that had a bit more recurring revenue or fee-based revenue was not that great. In those days, you could sell a transactional based practice. So a practice that has over 30% in transactional revenue was still something that was appealing to most buyers. The gap between the transactional and the fee-based practice has gotten larger and larger, just like the gap we're showing you between tech challenge and tech enabled practices. So recurring or fee-based revenue today is over 90%. And very few practices actually have a large transactional revenue basis. Those who do are very hard to sell. In fact, we've had some that, literally at a multiple of 1 have been difficult to sell. And the big difference there is that the models are so different, and they've gotten more different over time. And that makes the marketability of the old model very, very challenged. We're looking at the same thing here, essentially. So as the difference between tech-enabled enterprises and tech challenge books of business becomes greater and greater, and that will certainly happen with adoption of AI and deepening of AI in our industry, the difference between the two becomes greater and greater, and it makes the marketability of the latter very challenging. And I would say it'll be hard to compete as well, which is a different type of challenge for those practices that are not willing to adopt. So we think a reasonable estimation of that is what you see on this slide, where the tech challenges practices go down to an average multiple of about 1.9. The enabled practices go to an average multiple that exceeds 3. Then that gap on a $1 million revenue practice increases to 1.2 million from the 400,000 that we were seeing today. So this obviously really is a pretty astounding illustration of where that is very likely to go, and we have a good roadmap for that, looking back at what happened to practices with a lot of transactional revenue, and that's certainly the case today. We also put together what we think is a potential model. We're trying to have a more conservative approach to it, but also the way things are accelerating, and they're certainly accelerating exponentially, which is not something that we've experienced with changes in the past to our industry. But implementation will take time. But we think there's an accelerated model that's also pretty viable here. Simply the difference in that gap between the two types of businesses. I think this could be largely, or maybe easily driven by how much technology and how deep it goes within that time frame will be the big driver here. But here what you see is, with the accelerated model or use case, the tech-enabled enterprise is getting up to a multiple of 3.3, and the tech challenge books going down to 1.7, just a little bit shy of 1.8. Then the gap becomes, on the $1 million revenue practice, over $1.5 million of monetization. So I think whatever model that you ultimately agree with, the message is clear. There's going to be a greater and greater difference over time. Time is certainly not a partner of those who are operating in the old manner, and could be very favorable for those who decide to implement. So, when we think about, the practices today, it's still the case that, a book of business has very strong value. The market for practice sales just has continued to get stronger. But again, time is a negative factor for those folks who are not going to implement it, because even if they're operating profitably, even if they have good client groups, etc., it will be the case that the differences in business models will outweigh those factors. And given the recurring revenue versus transactional theme, where we've already seen this happen, there just becomes too big of a difference between the models, and people don't favor that book advisor-centric model any longer. So let's see what the options are then. Obviously there's a lot of opportunity here. There's some risk to some, and really the biggest risk is doing nothing. But there's certainly 3 paths that we've identified where the outcomes are really positive. So let's look at those paths, and just we'll go a little bit deeper on this. But path number 1, a motivated person or team who really embraces new technology. I just literally had a call with an advisor who was very optimistic and embracing that technology right now. Decides to build it. They want to adopt it. They're just literally waiting for it to be available. It's not deeply available yet. And they look forward to that. They're enthusiastic about it. So path 1 is building depth. Path 2, I'm an advisor who's not always been the most, eager to adopt new things and so forth, but I see the writing on the wall, and I understand, I don't want to get left behind in the future. That's the near future. And I'm going to join depth. So I'm going to team, with a practice, probably a tech-enabled enterprise, and really take advantage of the work that they are already planning to do or have done. Path 3, if you don't see yourself in either one of those models, is monetizing equity sooner than later. And that's a great path for, those people in, my generation, the baby boomer generation, and I get it. If, they've seen so much change over time and it just keeps accelerating, just decide, this is the one. This is probably the biggest change that anybody will experience, and so they're just not going to take part in it. But I do want to monetize, the equity of what I built over the last 20 or 30 years, and do so at a time, when the value is quite high. Number 4, as you can see here, that's really the dangerous option where the risk is, and that's doing nothing. Certainly, we don't recommend that for anybody. So let's go a little bit deeper into these 3, if you will, options, not the 4th option, but really the 3 that are associated with a positive outcome. If you are going to build the depth, and if you make that decision and you're enthusiastic about it, that's excellent. I think there's a little bit of difference here that needs to be acknowledged, though, in that this is not a DIY operation. If you're with a broker dealer, obviously, they're going to be very thoughtful about how to implement it across their operations and systems and processes and so forth. And from what I've seen so far, what they're doing, even though it's a little bit slow coming, which is probably being thoughtful, is being done very well. But you're not going to DIY this. This is not an area for piecemealing, and I think the commitment to going in on building the depth, or doing it yourself in terms of building your practice around it, is going to require probably a deep implementation and a deeper engagement than you've had with other rollouts of new technology systems and processes. Because where this becomes really valuable is when it works across the system, and the AI is able to really look at information from all of the different lanes of your business and combine them together for insights that just don't exist today. We're doing that in our own business actually today. So option 1, build it yourself. Follow the support of the platform that you're on, or if you're an RIA, follow the support of professionals. Don't do it yourself, but build it yourself, but don't DIY it. And really plan on deep integration into your business. So you've got to be fully committed here. It's not something where you stay at that shallow level of implementation and hope to keep up with those who are going deeper. Path number 2 is join depth. I think largely I could see this as the easier path. in many ways, and especially those who don't plan to exit the business in the near future. There is one caveat, though, and that is, oftentimes when you've been running your business a certain way for the last 20 years or whatever that case may be, it's difficult to adopt someone's systems, processes, culture, and so forth, and that's what this will largely require. There will be a lot of options in how you can join depth. I can think of some that are already happening. You could sell and stay, so sell the equity in your practice to one of these tech-enabled enterprise firms, and then if you're not ready to fully exit, you stay on and largely continue to service clients, which is probably what you enjoy doing anyway, giving up a lot of the responsibilities and the hats of ownership. You could partner with a firm, so maybe selling part of the equity, but retaining part of it. And again, usually those models also involve a lot of giving up of the operational sides of running and the ownership side of the operating the practice. And again, that's a favorable outcome for a lot of advisors. But again, the trade-off is you really have to be open to adopting another firm's processes, culture, etc. The other model is, and this is a common one, kind of the aggregator or affiliate model, OSJ model, is you roll up under another larger tech-enabled enterprise practice, and you're able to access a lot of their systems and processes without inventing them yourself. And generally, you do so by, having some type of haircut or payout with that enterprise partner. So, good option here. I think, don't want to take the time. You don't, probably want to continue to complicate your life as a business owner, but you're not ready to exit. Some really good options there. Just simply join another practice that's going to do the heavy lifting for you. And then, the last positive outcome model is for those who are not open to doing the first two options, is really monetizing equity sooner than later. And I wouldn't wait too long if you're in this lane. And there's certainly nothing wrong with this one. What we've seen, in the last 7 years or so in our industry is an expectation that we're going to, see this baby boomer group retire en masse, and that's never really happened. Many of them have delayed retirement. But the interesting thing here is that the burnout factor in our industry is high. It's the number one reason that people give us that they decided to sell their practice, actually. Number one is burnout. And if you think about the hurdles that created, that being the number one reason people sell, this is not a comparable hurdle. It is literally not. They've seen things like increases in compliance, increases in technology that they have to use, social media marketing, all of those things that add up to that burnout factor have certainly been significant, but they've never been at the scale that this is going to be in terms of change, and the rate of change here, as I mentioned earlier, is exponential, versus incremental. So, I think it's relatively easy to identify yourself in this group, and, the opportunity is still excellent to monetize equity. It's quite high right now. Valuations are at an all-time high. And, exit on your own terms. Don't let the decision be made for you by burning out or the number two item, which people state as far as the reason to sell is life events. So those two are decisions being made for you and not by you. So a great option still, and for those folks, I think, the 3-year window, will come sooner than later. And I wouldn't count on it taking longer than that, literally. We're already seeing with broker dealers, the implementation of AI into the tech and operational stacks is starting now. It won't take that long for it to get deeper. I think even by next year, by the end of next year, we'll see it quite deep, where it's operating independently in a lot of those stacks. So if this is your lane, it's just good to recognize it, start taking steps, get evaluation, work with a professional to help you transition your practice and really take advantage of the current very strong market for monetization. And then lastly, the fourth option, obviously we don't recommend this to anybody. If you just stay doing what you're doing, you're not adopting, you're not joining, you're not monetizing, then the options there are not good, and you're likely just going to see a decrease in value, and certainly that's not what you want, for yourself or your family, clients, etc. And then, I think lastly, one of the key messages here is that, because this growth, this change is exponential, it's the case where time is not a neutral factor any longer. No one has fallen behind yet. I think I could safely say that. It's just being implemented now. Implementation is certainly trailing ability of the models. There's no doubt about that. The ability is quite amazing already, but the implementation in business is a little bit lagging for good reason. But time is important, and choosing one of those lanes is really going to be, I believe, maybe one of the biggest decisions you'll make for your practice, for your business and your legacy. So with that, I'm going to hand it back over to Travis. If anybody wants to contact me as a follow-up, we're always happy to schedule time to discuss specific needs of your practice. If you find yourself, really trying to identify which of those lanes that you might be in, and what next steps are, and so forth, please feel free to take your phone out, take a picture here of the QR code of my contact information, and I'd be happy to schedule time with any of you on the call today. So Travis, I'm going to hand it back over to you, and hopefully we've got some questions queued up.
Thanks, Todd. Nothing right now, but again, if you have questions, there is the chat function or the Q&A function should be at the bottom of your screen. So we'll give it a little minute, and if any of you have any questions, um, please ask. While we're waiting, Todd, I do have a question.
Okay.
Um, how would you say, I guess, the importance of how advisors service their clients? How do you foresee that going forward in the future?
Yeah, and I think that's a question that's on a lot of people's minds, and if I expand the scope of that, if you don't mind,
Yeah.
the question, which I've heard quite often, is, is this technology going to replace the advisor? I mean, that would be the natural, extension of it, if you will. I don't believe that at all. I think the advisor, their time, and what they can provide to the clients is going to be more and more valuable. If you think about, your own lives and the fact that not only in your professional life, but your personal life, things are becoming more and more complicated. The rate of change is absolutely crazy in many cases. You need to have someone to talk to. You need an advisor who can be an interpreter. Information is going to become like atmosphere. So it's not, you're not the gatekeeper of information anymore. You're the provider of perspective. And I think that, for advisors who embrace that, and in some cases need to change the perspective, to be fair, the good news is the perspective that's going to be valuable is a human perspective, largely, so don't do the heavy lifting of the information, don't do the heavy lifting of analysis, but really focus on, being a human in front of them, being an interpreter, and really providing the perspective that I would argue they're going to need more and more.
Awesome. Appreciate that. Still no questions at the time, so you did a great job of explaining today's topic. We'll still give it a couple more minutes here to see if any come in. Again, the Q&A section at the bottom or the chat feature as well. Feel free to ask any questions.
And if anybody has questions, you're maybe not as comfortable sharing, I see we had one pop up, reach out to me. I'm happy to schedule some time and talk about whatever's on your mind regarding these subjects and the things that they're related to. This is why we're here today.
Yeah, we do have a question. Will the deck be sent to everyone on today's call to refer back to it? I believe there will be a recording. So yes.
So it looks like we don't have any other questions. Hopefully we did a good job explaining today.
Yep. Yep. Again, as Todd mentioned, if you have any questions or want to schedule a call, again, you can see there's the QR codes on the screen there. Feel free to reach out to him or myself. We'd be happy to to discuss any questions you have. So with that, we'll let you get back to your Tuesday, and thanks everyone again for attending.
Yeah. Thank you for your time.